She made $43,800 a year. She had $61,000 in debt. And she paid it off in 26 months on the same salary, no side hustle. You're probably staring at a stack of credit card statements, a student loan notice that says minimum payment due, or a medical bill you never expected. Your bank account feels like a leaky bucket, and every night you wonder if you'll ever climb out. By the end of this story, you'll have a step-by-step plan that lets you turn a $43,000 income into a debt-free life, even if you're stuck at a $3,200 take-home paycheck. Meet Maya, a 32-year-old retail manager in Ohio. She earned $43,800 in 2023, carried $61,000 of mixed debt, including $22,000 in credit card balances, $28,000 in student loans, and $11,000 in a medical bill, and felt the pressure of a rising Fed rate environment that made every dollar count. Quick win: the first thing she did was cancel 3 free credit card offers that were actually costing her 22% APR annual percentage rate, the real interest you pay each year. That alone shaved $120 off her monthly interest bill. Section 1: The Debt Audit That Stops the Bleeding. Maya started by printing every bill, every statement, every email about debt. She listed each balance, interest rate, and minimum payment in a simple spreadsheet. The total monthly minimum was $1,340, and the interest alone added up to $420 each month. Action step: grab a piece of paper or open a free Google Sheet. Write 3 columns: balance, APR, minimum payment. Fill in every debt, even the tiny $45 medical copay. Seeing the numbers on one screen makes the problem feel concrete, not abstract. Next, she sorted the list by APR, highest to lowest. The credit card with a 22% APR sat at the top, followed by a student loan at 7.5% and a medical balance at 0%, but with a looming collection deadline. She then applied the avalanche method, pay extra toward the highest APR while keeping minimums on the rest. The avalanche is different from the snowball method, which focuses on the smallest balances first. Avalanche saves you the most interest. She set a target extra payment of $350 per month. How? She examined her spending habits. Maya realized she bought a $5 latte every weekday, costing $260 a year. She swapped to brewed coffee at home, freeing $130. She also canceled a streaming bundle she never used, saving $12 a month. With those $142 freed, she used a free budgeting app to allocate the remaining $208 to her extra debt payment bucket. In the first month, her total payment rose to $1,690, knocking $350 off the highest interest credit card balance. Did you know that paying just $100 extra each month on a 22% credit card balance can shave off more than $2,000 in interest over 3 years? Section 2: Harnessing the Power of Balance Transfers Without the Fees. Maya's next move was to open a zero APR balance transfer credit card that offered a 12-month promotional period with no fee for transfers under $5,000. She transferred $4,800 from the 22% card to the new one. The promotional APR is 0%, that means no interest for the next year, as long as she pays off the balance before the promo ends. Step you can. She called her credit card issuer and asked for a lower rate, citing her perfect payment history and the fact that she just transferred a large chunk of the balance to a 0% card. The representative hesitated, then offered a temporary 3% reduction that cut the APR from 22% down to 19% for the remaining $16,200. That small change trimmed her monthly interest charge by roughly $80, which she redirected straight into the avalanche pile. Next, Maya tackled her student loan portfolio. The federal loans were stuck at a 7.5% fixed rate, while a private lender was willing to refinance the same $28,000 at 4.2% for a 10-year term. The monthly payment dropped from $349 to $287, a $62 saving that she earmarked for the high-interest credit card balance. Over the life of the loan, the lower rate shaved off more than $7,000 in interest. She also explored a personal loan consolidation option for the remaining medical bill. A community bank offered a 5-year loan at 5.9% with a $500 origination fee. By borrowing $11,000 and repaying it over 60 months, Maya turned a 0% promotional balance that would have required a lump sum payoff into a predictable $213 payment each month. The trade-off was a modest interest cost, but the certainty of a fixed schedule helped her stay on track without fearing a missed deadline. To keep her cash flow steady, Maya set up an automated pay-it-forward rule. Every time she received a paycheck, she transferred 10% of the net amount into a separate debt extra account before anything else left her checking. With a $3,200 take-home salary, that meant $320 automatically earmarked for debt each pay period, never to be touched for groceries or rent. Automation removed the temptation to spend that money and turned discipline into habit. She also built a tiny emergency buffer to avoid falling back into credit card debt when an unexpected expense arose. By tucking away $50 from each biweekly paycheck, she accumulated $1,300 in 3 months, enough to cover a minor car repair or a broken appliance without tapping her credit lines. That safety net prevented a new balance from forming, preserving the progress she'd already made. Maya discovered a debt snowflake technique that turned everyday micro-spending into extra payments. She rounded up every debit card purchase to the nearest whole dollar and transferred the difference to her debt extra account. For example, a $7.49 coffee became $8, adding 51 cents to the fund. Over a month, those fractions added up to $12, then $24, then $48 as she grew more mindful of rounding. Those seemingly insignificant amounts compounded, shaving off a few extra dollars of principal each cycle. When tax season rolled around, Maya filed her return early and chose direct deposit into the same debt extra account. Her refund of $1,250 landed there in a single splash, instantly reducing the credit card balance by almost 2%. By treating windfalls as debt payments rather than discretionary spending, she accelerated her timeline by roughly 4 months without altering her monthly budget. She also leveraged employer benefits that many overlook. Her company offered a commuter expense stipend of $100 per month, which she redirected into her debt bucket. In addition, the firm's health savings account allowed her to set aside pre-tax dollars for medical costs, effectively lowering her taxable income by $200 each month. The tax savings translated into an extra $30 she could funnel toward the 19% credit card balance, further reducing the interest accrual. Another lever Maya pulled was the strategic use of cashback rewards. She switched one of her remaining cards to a 1.5% cashback program on groceries, which she used exclusively for that category. After 3 months, the cashback rebate totaled $45, which she immediately applied to the credit card principal. By aligning rewards with debt reduction, she turned a passive benefit into an active repayment tool. She also examined the hidden cost of late fees. One of her student loan accounts had a $25 late fee clause that would trigger if a payment slipped past the due date. Maya set up a text reminder 2 days before each due date and scheduled the automatic debit to hit a day earlier than required. This simple tweak eliminated any risk of a penalty, preserving the $25 that would otherwise have been added to the balance each month. To keep morale high, Maya celebrated milestones without splurging. When she knocked $10,000 off her total debt, she treated herself to a modest home-cooked dinner with friends, costing $30 total. The celebration reinforced progress while staying within the budget, preventing the common pitfall of a reward binge that can undo weeks of effort. Finally, Maya revisited her career trajectory. She requested a performance review and presented data showing she consistently exceeded sales targets by 15%. The manager responded with a $2,500 raise, bringing her annual salary to $46,300. Even though she didn't rely on a side hustle, that modest increase added roughly $208 to her monthly take-home pay, all of which she directed to the avalanche strategy. In less than 2 years, the combination of rate reductions, consolidation, automation, and incremental income boosts compressed what could have been a decade-long journey into just 26 months. By layering these tactics: rate negotiation, strategic refinancing, automated allocations, micro-savings, windfall deployment, benefit optimization, reward redirection, fee